Well, good evening, everybody, and welcome to the August edition of the Investing Roundtable. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing, and I'm joined here by Ken Cavola of the Better Investing Mid-Michigan chapter, and our dear friends Cy Lynch from Atlanta and Hugh McManus from California. And we just want to wish you all a wonderful good evening as you look out over that northern Michigan lake on the cover slide. And the stock market has been behaving itself quite well lately. I think there are many smiles in the room. How's the stock market been treating all of you?
Generally good.
I'm happier than I've been in a long time, Mark, okay? And that includes all this sitting around inside the house. So,
well, I know that people that have been committed and persistent about long-term investing, along with some of the opportunistic stuff, have actually fared pretty well here over the last several months. So let's go ahead and get on with the program. But again, we are kind of starting our second decade, having completed a decade of doing this, monthly webcasts since 2010, and sitting on some pretty good performance results. And you guys are pretty good stock pickers. Okay, let's go ahead and get the legal paperwork out of the way first. No investment recommendation is intended. This is all about education, illustration, and demonstration of philosophies and methods of the modern investment club movement as promulgated by either NAIC Better Investing or Manifest Investing. Some of the views, in fact, all of the views are our own. We could own shares in the companies that we talk about. We'd like to disclose that, and we certainly try to where we can. If you'd like to be added to a reminder list to get a gentle email reminder from Natalie Cavola a couple times a month, she doesn't overdo it, please send an email to ncavola1@comcast.net. If you'd like a copy of the slides or if you have a follow-up question, please send an email to markr@manifestinvesting.com. Moving right along, this is our standing agenda. We're going to continue to do things the way we have been doing them for years. We are going to try to condense the first part of the program a little bit, try to leave room for an educational topic in these monthly sessions, and then all of us, as undisciplined as we are going to try to spend less time on repeat selections and leave a few more minutes for new selections in coming months and just kind of see how that goes. We close the session with an audience poll where you all get to vote, and then we do try to leave some time for open question and answer session. You can see the 4 selections on the agenda. First, Financial, Paychex, BP, and BioMarin Pharma. All right, just as a quick reminder, we've been doing this for 10 years. Last Tuesday evening of the month, we do try to share with you one of our single favorite actionable investment opportunities. We do keep track of what we do. We'd like to beat the long-term performance of the Wilshire 5000 by 5 percentage points. That's 500 basis points if you speak that language. And we'd like to see a majority of our selections also outperform that Wilshire 5000 as a total stock market benchmark. Without any further ado, here is our roundtable performance over the last 10 years plus 1 month. And we check in with a rate of return since inception of 17.6. Again, mirroring investments made in the Wilshire 5000 over that same time frame would be 11.9. So our relative return is still checking in north of 5% at 5.7%. But you can see that even though we've actually been climbing in our long-term absolute return, the market's been climbing a little faster in the last few months, and that's why you see this slight decline on the right. We're not worried about that. It's the type of thing that we've seen. All of us have been investing for 3 or 4 decades, and we've seen this type of behavior many times over, that sometimes it just takes time for our selections to kick in, and no cause for concern at all. 51% of our picks have outperformed those benchmark selections. And our net cash flow, again, that's the net of all the sell transactions out of the portfolio. We keep track of the total cash flow of the tracking portfolio. We would actually have a positive cash balance of $68,504. That's after investing $565,000. And it's really kind of phenomenal when you think about that. We're, as some people would put it, we're playing with the house money. And we have approximately $400,000 in actual positions. Here is that portfolio, tracking portfolio. Again, not going to spend a lot of time on it, but you can access it at that link, whether you're a Manifest Investing subscriber or not. It's a public dashboard. You can see all the selections. The top 20 positions are on display here. The legend up at the top tells you how many times those positions have been repeated. Anytime a decision is made by a knight or a damsel or an audience poll, we put $1,000 into that stock. So in the case of Microsoft, you can see that now has a value of over $47,000. That's actually only been selected 5 times. So $5,000 invested in Microsoft is now worth $47,000 and change. So you can decode that top to bottom. The average stock in the stock market right now, at least the ones that we track at Manifest Investing, is approximately 8%. MyPAR stands for Manifest Investing Projected Annual Return. It's a median return forecast for the stock. So 8% is the average. We'd like to stay wishfully 5 percentage points above that. You can see that we're slightly under that at 11.7. Again, our stocks have been doing extremely well. It's almost kind of hard to stay ahead of it. But that's better than it has been in quite some time. Again, that 11.7 compared to 7.9 is basically a 4% advantage. We'd like to see that at 5. The only way you do that is by divesting positions with lower return forecasts and replacing them with stocks that have better potential. The quality of the portfolio is strong and capable of actually tolerating some speculative or special situations in the portfolio. We do aim for about 12% plus or minus on the weighted average growth of the portfolio. So everything's pretty much in order. We'd like to keep that number up at 12 or better, but I think it's full speed ahead. Any comments or questions at this point?
The only comment that I have, Mark, and I've not completely sorted out exactly what's going on, is that you have a little bit of a tale of two markets that's distorting the MyPAR versus portfolios a little bit. That and I think some of it is that you have such a large financial arena, financial stocks, largely banks, but not limited to banks, that are occupying the very high return potential. And so stocks that are not financial stocks tend to be falling under the median a little bit. And like I say, I've not completely been able to figure it out, but just about any better investing type portfolio right now seems to be very much out of whack in my experience vis-a-vis MyPAR, or seeking that 5 percentage points above. And that applies, for example, the growth stock portfolio outlook portfolio I'm use as a model portfolio in Better Investing Magazine, same thing. And I'm using VL map rather than MyPAR there. And again, there's a little bit of what I'm calling a disruption in the force. Again, it's gotten closer. I mean, it was really kind of wacky back when the recovery started in April or so, but
yeah, and I think it's very perceptive. About a third of the companies in the database are financial stocks. And one of the topics that we've been kicking around is why are so many financial stocks ending up at the top of the screening results? And part of that story is those stocks do not fully reflect the plateauing of results that is coming. So yeah, you're right. The added higher return forecast from the financial stocks is probably pushing that my par a little bit higher than it should be. So it's a good way to look at it. We'll be spending much more time on that at a future bull session, some of our Tuesday afternoon sessions that we kick around. Let's go ahead and keep pressing on. Again,
Mark,
Go ahead,
I'm going to
Ken.
answer a question from Felicia Williams. Okay,
Sure.
Felicia wants to know, when did that $5,000 turn to over $47,000 in Microsoft? And we keep track, but it's not on the dashboard, Felicia, about when we made the first buy, the actual date of the first buy. And then there were 4 other buys. So this is not a single position of $5,000. This is 5 separate positions of $1,000 each. And the time constraints sometimes are as far apart as a year or 2 or even 3 years apart. So we can give you that information if it's really important. We keep it all, but it's not displayed on the dashboard.
Yeah, and I can tell you that Hugh McManus selected Microsoft twice in 2011. And the reason I know that is those positions, those $1,000 positions, have grown into $13,000 and $12,000 balances. So that's half of it right there. I don't know the 3 subsequent selections, but it was definitely Hugh, and he takes a bow.
Thank
Take an
you.
Irish bow from the California coast.
Yeah.
It works. Yeah, I can remember that many of us held our nose when he made that selection. So just goes to show. All right. Anything else, Ken?
No, we're going well. Thank you to Hugh and Cy for doing answers in the back room as well. I have 1 or 2 of you indicating that you're having sound problems. We're not hearing sound issues from the audience, so it might be your own internet. And if you have somebody else in the house that's doing a lot of streaming, that might be part of the issue.
Yeah, we have run into that quite a bit, and there are a fair number of storms around the country, including some firestorms. All right, let's go ahead and press on. I really would like to get the first part of the program done a little bit faster than we have in the past. Stocks on the hot seat. We basically place the stocks that have the lowest return forecasts on the hot seat. In this case, FedEx. I had selected FedEx approximately a year ago, so $1,000 has become $1,531. We really like when that happens. The projected return, and we'll look in more detail here in a second as we audit it, has dropped down into low single digits. We're not ever in a hurry to sell something like a FedEx, but we do tend to house clean from time to time. We don't have any companies that are lagging the market by 20%, with a couple of exceptions. We've given Schwab and Air Lease exceptions along with Ardelyx as special situations. The Schwab thing is related to the merger situation with, help me, which company are they buying? Ameritrade, right?
TD
Yeah.
Ameritrade,
TD
right?
Ameritrade.
Right. So that we basically give them some extra slack as a special situation. There aren't any positions with an RSI greater than 80 today. FedEx was at 83.6 a couple of days ago, so that one is the only position that has been red hot. Here's a quicker look at the company. Company growing at 4% with, according to Value Line, projected margins in the 5.6% range. A PE of 15 is actually fairly easy to justify based on this picture here. You could argue a little bit more, a little bit less. But what it comes down to is a company with a mid to low single digit PAR, very consistent with the projected return on value, very consistent with these numbers. And I'm just going to say high five at the water cooler and move on. We'll reduce the tracking portfolio by 1 position. And just in our continuing effort, I don't think we want to be making wholesale changes, but FedEx has really been on a tear. Oh, I thought I had a chart in here that showed it. It has really been on a tear here in the last 6 months, basically doubling in the last 6 months after it had gone down. You can see that there was a pretty good disruption related to the early days of COVID, but really cranking along quite well. You can see
Mark,
the
we have a
numbers.
hand in the air. Felicia has her hand in the air. Let's unmute her and see what she has to ask, okay?
Okay.
Felicia, you're muted on your side, so we can't hear you until you choose to unmute. And we're going to assume that that's an inadvertent hand, and I'm going to take it down and let you continue, Mark, okay?
Okay, so we'll just go ahead and walk away from FedEx as a victory. Again, it has a low return forecast because the stock price has gone up so much so quickly, and we like when that happens. All right, so let's go ahead and turn to Ken's selection, First Financial. I believe he selected it last month, and he's doing a repeat selection, and it actually goes back a few years to a couple of successful positions by Cy a few years ago. Go ahead, Ken.
Yeah, this is only the third time that I've chosen the same stock 2 months in a row. I've owned First Financial in my personal portfolio and in 3 of my different club portfolios for a considerable amount of time. Personally, I've owned First Financial for about 7 or 8 years. You can see that it's a Texas-based bank with representation in all the counties in dark blue. So it's growing, but it's still considered a regional bank. Next slide, Mark. It represents just under $10 billion in holdings. It's grouped into 12 separate regions, been around for a long time, and its basic growth markets include a 50-mile radius of the metroplexes of Dallas-Fort Worth and of Houston. Next slide. One bank, 12 regions. That's the concept. It's one bank that shares all of the things that a single company can share, but it's divided into 12 regions with 12 separate presidents, and they like to keep the bank as locally focused as they possibly can. This idea of making sure to meet the needs of the community seems to be on almost every single slide that they talk about when they're speaking about what their goals and objectives are for the bank itself. Next slide, Mark. Its loan portfolio is structured with a fairly decent chunk of the loan portfolio in single family real estate and in commercial real estate, a little bit in agriculture, a little bit in consumer loans, very little of it in loans to things like airlines or cruise ships or even hospitality that might be really negatively impacted by COVID. Next slide, please. You can see the lines, and there's a traditional extra line on this graph. We usually see green, pink, and blue. You see a turquoise line in addition, and that turquoise line is representing what the bank has done in the first quarter. Now, if you click just once, Mark, you'll see that we went from last month's presentation to this month's presentation, and another quarter was added on. That growth in assets is now matching pretty well the growth in sales. That bigger jump in assets was bringing in an annexation of a local bank, but now we're back to the whole company growing, and I like the parallel nature of first to second quarter on practically all 4 of these lines right here. You can see that the last quarter's growth in sales and earnings was pretty substantial for a reasonable sized bank. It was past 20% for each of those metrics. Next slide. I'm looking at numbers that haven't changed since last month because we're still in the middle of the fiscal year. I do have one more data point on the Chronicle. That's the graph at the bottom of the slide. So I'm showing that par going forward at the end of March, at the end of June, par was a little bit lower than it had been 1 month earlier to that, but it's still in kind of historical high regions compared to the rest of that graph right there. And that's when I would like to invest in any company. But I think the bank is an especially enticing thing to take a look at right now. Next slide. The SSG that I didn't basically change at all from last month, keeping an average high PE of 30, an average low PE of 20, and a payout ratio of a little bit more than 40%. Stays a buy, pretty decent upside down ratio, nice total return, really decent projected average return, par value. I'm thinking that I'm a little bit more conservative than the analyst that Mark is following when he generates that 17.7% par number. So I'm really hoping Mark's a more optimistic view from the analyst point of view is better than mine, because that means I'll do even better. But I'll settle for 12% growth in almost any company that I'm looking at purchasing. Stock price, and this is Friday's stock price, I think, of $30.91. It is higher after the close of trading today. So do your own SSG, draw your own conclusions. But if you're looking for a bank, I think First Financial is a great bank to take a look at.
Thanks, Ken. Yeah, and there's a bunch of regional banks that come up on the screens that I think if you approach them in the same conservative fashion, probably make a lot of sense. All right, with that, we'll switch to Cy and Paychex. Were you going to say something, Cy?
Yeah, I was going to say I'll kill two birds with one stone. We have a question. What does the go ahead and go back to that slide is good, Mark.
Okay.
What does the asterisk next to First Financial Bank shares mean? If this was a general question earlier, but
that just means it's not in the main value line. First Financial, you'll find it in the extended value line. It's not covered with an analyst report like the 1700 main value line stocks are.
All righty, and that's what goes throughout manifest. So if you see that, that's what it means. Next slide now, Mark. We'll talk about value line and Paychex. Paychex is what. Let me go ahead and introduce tonight because I like doing different things sometimes and different approaches for teaching points, but for various reasons, the last few days have been very busy. This pick is an example of how you can use your experience as an investor and the tools that we are given through Manifest and through Better Investing in the approach to do what I feel very comfortable and confident about choosing stocks without necessarily overworking yourself. So that said, and I'll be a little more specific as we walk through. Paychex is my pick tonight. It's a new introduction to the portfolio. This is the value line lead page. Notice value line has a projected low return over the next 3 to 5 years of about 7. Not on the high side of things, but again, to me, an interesting potential. Notice also in the 18-month price target. Again, we're not trying to time markets or anything, but 18 months gives you a little bit of, more than just a trading range. It's 35% at 15% a year. That's saying that we're in the ballpark if other things check out. So there's some reason to look at Paychex. Next slide. Here's perhaps the most attractive reason I find for looking at Paychex today is the history of up, straight, and parallel. You see a slight little bit of deterioration in the pre-tax margin, pre-tax profit actually in this case, although because of the sales staying steady, that actually does reflect a slight decline in the margin as well on this slide. But again, when you're running 35% plus margins, slipping a percentage point or two is not anything to get overly concerned about. Next slide. So I was challenged by Mr. Robertson not to do a repeat selection tonight. So he barred me from saying Cognizant or EPAM, or really I was looking at maybe AbbVie, even FFIN, till Ken took it from me. So I had to find a stock that was new. Given the fact that although we are coming out of an actual bear market, I think in many ways we're in a potentially maturing market. We're certainly in an uncertain market for all kinds of reasons. So I decided let's go for a little bit of an odd pick. Go very high quality at 90, very strong financial strength at 90. So very solid companies from a quality standpoint, and throw a yield in. I don't usually scream by yield. And I don't usually use yield that much. But for this pick, I said, let's go for an above the market yield to give me a little bit more cushion and potentially income. And here are the results. You see, it did not come up with very many companies at all. Paychex ranked by par is the second highest par. And notice stability of the 100 on EPS. So and it's among the highest growth. It's not a super fast grower by any stretch of the imagination at 7.3%. But again, among this group of companies, which again is not unusual for high yielding companies to be somewhat slower growth, Paychex had a good growth rate. Next slide. Did a quick industry study ranking by quality. And you see here, basically Paychex is tied for the second highest par in the industry, and it's also tied for the highest quality, and again has the highest yield in the industry. So TransUnion would have been a close second potential pick here. Had I had more time to do a more thorough analysis and study, I probably would have looked closer at TransUnion, but notice it has a minimal yield, and I was looking for yield in this case. And also I'm trying to do a quick search. I'm familiar with Paychex over the years. I do not currently own it, but I do know the company. I'm not as familiar with exactly what TransUnion is doing as a business today. It would have taken me longer to audit the results a bit. Next slide. Here's Paychex as they describe themselves. If you're not familiar with it, they do payroll benefits, human resources, insurance services. Their market is primarily small and medium-sized businesses. They leave the really large companies to in-house services, or to formerly ADP was one of the big companies doing in this area that did that sort of thing. They're no longer publicly traded, but they leave that market to other people. But what I thought was very interesting down there near the bottom of their description is that they pay 1 out of every 12 private sector employees in the U.S. So they have a great expense in the business. My research of the company itself, going beyond just my general knowledge of Paychex, I skimmed their fourth quarter presentation and 2021 outlook, and there's the link there. You could just go to the Paychex website, investor relations, and you'll find it there. I will just comment, they call their current fiscal year 2021 because it ends in May of 2021. When we get to the SSG data in a moment, you'll see that the last full fiscal year is called 2019, and that's just the way that the tools, when it's May or earlier fiscal year ending, they actually date it the prior year. So there's a disconnect between the naming of the fiscal years, but we're still talking the same time frames. Next slide. I just wanted to show you that Paychex is a high-tech company and is really sexy and deserves your attention this evening, because look at these things they're into: wearables, voice recognition, and especially AI over there. So, and that's out of that.
Too many political conventions, Si, okay?
Yeah, I wasn't aware that we were at the convention tonight.
All right, next slide. And here are my judgments on Paychex. This is the a preferred procedure, expected income statement off the online tools. I'm projecting a 7% growth rate going forward, which is right in line with history and pretty much the projections of analysts and the company, although the company's next 12 months is a little under 7%, but they will get back up to that. Expenses and taxes, you see, that's right in line, again, both with history and the company projections, and a slight decline in shares for earnings growing a little faster than sales. I used a 30 high PE and an average PE of 22.5, and like Ken with First Financial, if Manifest's average PE of 24 is attained, I'll be even a little happier because it'll give me a little bit more of a boost. Next slide. And then here's the bottom line with that, projecting again a 2.5 to 3.5% yield over the next 5 years, annualized, a potential high return of up to 15%, and then the average return using average PEs 9.7, a little below the Manifest 10.2, I believe it is, pick. But I'm very happy in this market with a 10 to 15% return when about a fifth of that is very solid in dividend and certainly potential upside.
Okay, well, thanks, Si. And I want to thank you for not going into jobs, some type of song or shouting your speech.
I was tempted, but
it's been rumored that kind of thing can happen. All right, let's.
Mark, before we go to Hugh, I have a hand up from Marie Meyer.
Okay.
And Marie, I'm going to unmute you and let you ask your question. Go ahead, Marie.
Oh, this is a while back, you were talking about Air Lease, but you had mentioned it, but you didn't discuss it. And maybe at the end, could you go back to Air Lease? It was on your list of, I think, ones that you were going to eliminate.
Yeah, we can come back to that one in the Q&A session. In the nutshell explanation is that it's not performing as well as we had hoped, but it is definitely a challenge situation with the airlines and the stuff that's going on and the confusion and chaos in that area. So that's why we are giving it a little bit more leash. But we can come back and talk about that in a little more detail. Thanks for the question. All right, let's go ahead and turn it to the Irish Petroleum King.
Yep.
Take us away, Hugh.
Again, I'm going to buy more BP and add that to the portfolio. This is a review of the process. I ideally like to buy what I've bought before and pile on more, particularly if the price has gone down. Unless something fundamental has changed with the company. It's not going to be the earnings machine I thought it was. But in this case, all the other companies I've been buying regularly are priced too high for me, relatively speaking. A lot of bad news around BP, which is what I like. I also like blue cheese, just so you know. So anything that's smelly and stinky, I will invest it in some way, shape, or form, or make the portfolio easier too. So we move along to the next slide. Just wanted to make a few comments because I was explaining to somebody online the other day. They found it quite funny. Maybe they have a warped sense of humor, but I was assuring this person that the goal that you have is twofold. You want to build wealth and outperform the market. And if you're outperforming the market, it almost assures that you're going to build wealth, because if you're doing better than everyone else, you're going to be a winner. And I argue that it is not difficult to do this. It's not difficult to outperform the market. It just takes two things, and they're outlined on the next slide. The first thing is you can't be a human being And the second thing is you have to own a time machine. Now that seems like a high hurdle for most people, and I agree it is. But if we skip to the next slide, we can talk about not being a human being, because I've talked about this many, many times. Our programming as an animal isn't designed to help us. It's designed to help the human being, and it's designed to help the human being evolve and get better, etc. So a lot of the things, the instincts that we have, are not designed to help us. They're maladaptations, like why we crave fat, why we scare and easily panic, why we have to agree with everything else in the group. And when you take these instincts that you have and apply them to the stock market, it's a disaster. I believe that we are fundamentally pre-programmed to be bad investors. We're emotional creatures, and you have to unlearn this 4.6 billion years of programming to try to be a good investor. And of course, for the time machine, which is starting on the next slide, this one is actually from easier. I mean, we're all familiar with the classic time machine. You go into the future, you jot down a few notes of what's going on there, especially with companies that are doing well or resources or whatever your fancy is. And then you travel back and you make the investment and wait for good news to happen. Trouble is, you check it out on Amazon, but take my word for it, this time machine is not readily available. So try this second one instead. And that is, on the next slide, it's a library. Instead of can't go forward in time, so why not go back? Why not go back and see what has worked in the past and what has worked consistently in the past and do that? And you'll find that points 1 and 2 that I raised are really related. You'll discover that the people who are long-term successful investors are people who can control their own humanity. They can be dispassionate about what they buy and when, and they're actually willing to accept a little bit of a smell from what they buy if they think this company will do well in the long term. And again, we celebrate people like Warren Buffett, particularly his mentor Benjamin Graham, and a dozen or so people who were stellar long-term investors. Earlier today, we talked about Irving Kahn and Walter Schloss and the gang, people who have sadly passed away. Irving Kahn passed away when he was 110 years old and was a growth investor right up to the end. But they are people who are successful investors because they do not follow the crowd. They don't go by anything that's instinctive. They're not emotionally driven human beings. Tough to do, but if you can do it, you'll be successful. So back to BP. Goodbye, library. Nothing has changed since last month except the stock price. It's dropped. And as I predicted, and I was shocked it happened within days of my saying it, they did cut the dividend in half. Made sense. I knew they were going to do it. Shell did it. And so I believed that after 75 years, by the way, I believed BP was going to do it too. And I also believe that this news was baked into the stock price. So the stock price didn't really do much. All oil companies are suffering. And in fact, an oil company will suffer if the imbalance between supply and demand is off by as much as 1%. Disasters ensue, headlines happen, prices of oil drop to $20 a barrel, or if it's off the other way, they'll jump to $100, $150 a barrel. And we've gone through that for the last 10 or 15 years, various different cycles. And while renewable energy is growing aggressively, I believe that when things get back to normal or near normal, oil will continue because it has been growing at a steady clip. Consumption has been growing worldwide at about 1 million barrels a year for the last 20 years. And it just keeps going. And I think it will continue to do so in the future. And that can only benefit BP in the longer term. So skipping along to what I think is the very last slide. And as I said in July, I'm counting on a recovery, very optimistic about that. Don't know exactly how it will happen. So I can't give you the path to the recovery from COVID, but it will happen. The pricing of BP for me is very inviting. There are echoes of what happened with Deepwater Horizon, except this price has been slashed even more severely. And it still has a dividend, which dividend was suspended during the Deepwater Horizon event 10 years ago, and it was polluting the Gulf. The price now is at a 25-year low. And so I want to add more BP to the portfolio.
Sounds good.
There we go. Some cash flow information on BP.
Not an exciting.
That, cash flow has been dipping and it's taken a big nosedive recently. Sorry, Mark, you weren't commenting there.
I was just going to say that's not up straight and parallel.
Yeah, I know.
Yep.
It's oil.
It's oil.
Super cyclical. The definition of cyclical, as I said, a 1% imbalance between supply and demand wreaks havoc. It'll do the same with your body. If you had a 1% difference in electrical charge in your body, it'd explode. But BP won't do that, so don't worry about it.
Yes.
But 1% can make a difference in a lot of complex systems, including the oil supply.
For those people who break out in hives over a graphic that looks like this one, again, keep in mind that we are assuming that we're in a very unusual period, and
Yeah.
the whole thing's an outlier. And again, this is a company that's basically going to be somewhere in that $300 billion range in the future. But notice the returns that he was pointing out, and they're actually backed up by the capital structure of the company. This is one of the higher projected return on values for companies that are this established. So could be very interesting. And I too believe that the globe is a big place, and there's more gasoline to be consumed.
It's going to continue for another 20 plus years. But there will be a pivot towards renewable, particularly solar. We're going to see that, I hope, in our lifetime. But in the meantime, I want to benefit from BP and the big infrastructure the oil companies have built. It's not going to go away.
Absolutely. All right. Well, thanks, Hugh. We'll add another one to the pile. All right. Well, now, in the spirit of blue cheese, screening for the bruised, battered, and beaten companies that are out there, what I did is I went into the manifest database, and we're going to try to make this available to everybody fairly soon, as we can get some programming time with Kurt. But I went looking for companies that have a double-digit projected return on value, and that's the histogram at the bottom is the distribution of the value line industrials, about 1,400 companies, and you can see that that's a pretty nice-looking bell curve. And I wanted to go shopping in that red circled area, and probably avoiding some of them on the far right, just as being kind of intense speculation. So again, I'm looking for companies that have the highest projected return on value in combination with low relative strength index. And what that means is, over the short term, companies that have been completely pummeled by the analysts and the stock price has been crushed. And the company at the very top of the list, BioMarin Pharmaceutical, ticker symbol BMRN, actually checks out pretty good in this regard. You don't see a RSI close to 10 very often. In fact, we ran a feature about 6 months ago where we looked at 5 or 6 companies that were approaching an RSI of 10, and we saw some really dramatic results back in March and April from companies like that. The moral of the story is that in a blue cheese situation, sometimes the analysts really pummel these companies. Like I say, this is a company that is loathed. It's hated on Wall Street. They basically messed up on part of what they were doing. It's loved by the lawyers that are suing the company on behalf of shareholders, and just things are kind of ugly at the company. But let's talk about specifically what is going on. There's an article in the Motley Fool about their disaster, which happened just a couple of days ago. This is a company which experiments with gene stuff for developing healthcare solutions. So when that unravels, it can be fairly ugly. And what they basically did, here is the supplemental report from Value Line. They actually have, I'm going to come back to this, but they actually have 6 active commercial healthcare solutions that are out there. This would have been number 7, and it's for the treatment of hemophilia. And you can read just as well as I can. They were expecting a favorable decision here fairly soon. And instead, what happened was the FDA came back and said that they wanted an additional 2 years of phase 3 testing. Hugh has covered the FDA pipeline process here in sessions in the past, and we all know that that's a fairly ugly result for a company like this. It's probably good news for a couple companies out there like Momenta, a couple others, but those who actually have hemophilia solutions on the marketplace. But for companies that have this type of approach, the gene therapy, I think you're going to see a lot of chaos and confusion here in the next several days. and it'll be interesting to see how it unfolds. Interestingly enough, the next actual quarterly update for this company from Buy Value Line is this weekend. So it will be interesting to see what they have to say about the company. But clearly disappointing. They're probably appealing. I don't know how that all process works, but it clearly was a wrench thrown in the engine. Here's a look at some of the fundamentals of the company. It is an early stage company, but I draw your attention to that top sales line, which has been pretty reliable over the last several years. And even after there's been a little bit of adjustments here in the last few days, still looks pretty good. It'll be interesting to see how that persists over the next several days. But again, that top line is doing pretty well, growing at about 17% a year, talking about a $4 billion company 5 years out. And I used cash flow because it is such an early stage company. Again, they're just turning to positive earnings now this year or next year, and they are projected to do fairly well going forward. But in the case of using cash flow for an early stage company, we can actually get positive numbers back since 2017 and going forward. So we get a look at the company a little bit earlier stage. This is some of the stuff that we've been talking about at the bull sessions. You can calculate a return in this situation. The stock price has dropped down to 73 from where it was. Interestingly enough, they really don't have that much debt. They've got a fair amount of cash in their checkbook, fairly decent looking returns across the board. Here is that relative strength index, which basically says, did the rhinos, the Wall Street analysts and institutions, go overboard in punishing this company? Time will tell. But again, I come back to the fact that this was the seventh product that they're trying to put out there. They do have 6 in place that are generating revenues and getting stronger all the time, that are building that foundation. So I think that's an important difference from somebody who's really only got a couple of irons in the fire when it comes to the pipeline and would have something like this happen to them. Here's a look at
Mark, BioMarin is an American, a United States company, right? That's just a typo, but it says cash flow per ADR, right?
Oh yeah, I should have clipped that off of there. Apologize for that.
Okay. All right. So this is a United States company. Okay.
Yeah, let me take care of that for the audience.
All right.
But just, a lot of these biotechs they're in the US, but for tax reasons, they have their headquarters overseas, sometimes in Switzerland, sometimes in Ireland. Like Jazz is, I think, legally headquartered in Ireland, but it's a US company.
Mm-hmm.
I got Ardelyx, but I saw one earlier that's the same. Think of the name in a second, but quite a few are headquartered overseas.
Yeah, a lot of them in Ireland, as Hugh said. So here's a picture of the damage. You can certainly see that something happened, specifically 2 days ago. Anytime you get a gap like that, and it basically dropped the company back. It had been doing very well since the doldrums of March. It had done pretty well, getting up to actually above $130 a share, and it's basically been cut in half in the last couple of days. So again, it's a blue cheese company for sure, and I'd like to add it to the portfolio. It'll be on a short lease, everybody, but again, it's all about pursuing an opportunity that it doesn't look like the end of the world unless that 2-year extension really does something that I don't understand, and that is possible. But I think it's probably more probable that the rhinos have overreacted, as they often do. So we'll go ahead and add BioMarin to the portfolio. Ken, I think
Thanks a
we'll
lot,
go ahead
Mark.
and go to the poll.
Mark, while we're doing the poll, there's been a number of folks that are interested in perhaps Hugh making some comments about Ardelyx.
Well, Hugh, do you want to sing along with Ardelyx while Ken runs the poll?
Yeah. Well, I saw a question was asked, is there any news on Ardelyx? And Ardelyx filed a new drug application with the FDA in June. I think it was June 30th, so right at the end of June. They have 3 clinical trials as part of the filing, which is good. Normally, you just need 2 or 2 successful clinical trials will put you in very good stead with FDA. They have 3, so that's good. That's good news. The next piece of news from the company should be what's called a 74-day letter. That should happen in or around September 11th. So that's a letter that the FDA typically sends to the company after it reviews the filing. And the letter basically said, we reviewed your filing and everything seems in order. Here's the date on which we'll give you a decision. And that date is usually 10 months after the original filing date. So if they filed on June 30th, that means it would be April 30th of next year. If there's a defect in the filing, they'll say, listen, we're not going to accept your filing right now. Here's what you need to do to fix it. That happens sometimes, but it's usually not that critical. Usually there's dialogue back and forth. So non-critical things are taken care of that way. And if the FDA is really happy with what they're seeing, they might say, hey, we're going to give you an accelerated review, so we'll have the results to you 6 months after your filing, which would put it right at the end of this year. I don't anticipate that. I think it'll be the standard 10-month review. So that'll happen in 2 weeks into September or thereabouts.
Thanks a lot, Hugh. We'd like to get a few more of you to vote. We have about 3/4 of the audience voting right now, so let's take another maybe 8 or 10 seconds. Use your mouse, just choose one of these. If you're on a different platform, use whatever you need to choose one of these. Doesn't cost you anything to vote. That pushed us up to 85% voting.
We're not accepting mail-in ballots, though.
Okay. That pushed us up to near 90%, so I'm going to close the poll. And this hasn't happened in a long time. We have a dead, whoops, I have to display it. That's last month's. Let's share the results. There we are. Looks like we have a dead heat going on, okay? So, Mark, we're going to add $1,000 to Paychex and $1,000 to First Financial.
Well, cool. Okay. All right. Well, we'll go ahead and field some question and answers here in a second. I did want to take a moment and just point out something that we have kicked around in a couple of different venues. If you're not familiar with this one, Jim Cramer came out with a COVID-19 index several months ago, and it's done quite well. I'll show you how well here in a second. He picked 100 stocks that he thought could possibly benefit from the situation and the challenge facing us. And we were nostalgic about our book review of Get Rich Carefully, where we basically make the case that he is a closet modern investment club participant. He really does think a lot like we do, especially when you get him to calm down and stop throwing furniture. I find that he's actually calmed down quite a bit here in recent years compared to a few years ago. Anyhow, he put out this list of 100 companies. It's quite a broad spectrum of, biotech type companies that would benefit, along with grocery stores and other types of things. And here is the actual year-to-date performance of the top performing companies. There's 100 companies in here. By the way, only 2 or 3 of them have gone down. So you're looking at the cream of the crop, the top of the list, and you can see that some of these have been just stratospheric, including Moderna. They're at the top, one of the vaccine leaders for the COVID, and all of the cloud companies that are here, and just some interesting sources of things to study. One of the things that we find most exciting about it is we created a dashboard, and you can actually view that dashboard with this link up at the top. And this is a couple days older, but one of the things that we find exciting is there's a number of companies that have been added to our database, like Zscaler, and everybody knows about Peloton. But we ended up with 12 or 15 new companies in the database. Again, some pretty promising type companies that you can take a look again at that link and kind of watch this play out. Notice that Regeneron is there, Microsoft, Salesforce, which is joining the Dow 30 here fairly soon, kicking out Pfizer and ExxonMobil. Just some good, clean fun with the dashboard, and the really neat thing is finding some of these companies. Ken, did you have any thoughts on that? I know you've been watching it.
I've been watching this index, and I think it's a great place to look for early stage companies as well. Now, the caveat that Mr. Kramer always puts forward when he talks about this index is that he does not expect some of these companies to do as well once we get back to a semblance of normalcy. He expects some of them to actually slow down quite a bit once we get back to something normal. And he expects that some other companies, larger ones in some cases, will figure out really quickly what worked for some of these very small companies and provide some very real competition for those companies. So this might not be a long-term kind of a play on some of these, especially early stage ones, but heaven's sakes, look at some of the ones that are up here near the top. I mean, we still have Amazon and Centene and Alphabet and AbbVie, Palo Alto Networks for that matter, and VMware up near the top of this list right here. So even if you're not searching for really small new kinds of things to take a look at, this gives you an idea for some really, really good ideas that probably are going to be with us for a while. I like Boston beer right in the middle, Mark.
There you go. Good selection. Yeah, it's an interesting list, and like we said, there's 100 of them there. I'll go back and correct the share total so that we get value to date, but going to be some good, clean fun. Coming attractions, we have been holding bull sessions Tuesdays at 2. You can get more information on those at Manifest Investing. And the September roundtable will be a month from now, September 29th. And most of our experience, our conferences or sessions are no longer face-to-face for the foreseeable future. I don't know if the decision's been made yet on the Stock Pickers Breakfast or not, Ken, but
informally, but not formally yet, Mark. But right after Labor Day, there'll be a formal decision on the Stock Pickers Breakfast.
We were hoping that by that point in time we could actually meet, even if we had to wear masks. But we are doing a webcast for Northeast Ohio and Cleveland on September 12th, and we'll probably see if they'll allow people from outside to, because it's a webcast, maybe they'll allow people to sign up for that.
I do promise everybody in our database that whatever you and I present at, I will ask if Natalie can send out a reminder to take a look at whatever's happening in that particular session as well. So that'll give us an idea. Cy, we don't have the 3 or 4 day Atlanta program here. Can you give us those dates?
Yes, I was just about to say that's actually this coming Friday and Saturday. The what would that be? The 28th and 29th of August. I'll be presenting on Friday. I'm sorry, it's the 27th, 28th, and 29th. The first day is a broker, and then Friday I'm doing 2 sessions along with Susie Artsberger of Better Investing Home Office and Pat Donnelly of the Pittsburgh chapter and Ronald Brune from somewhere in California. I'm trying to think which chapter he's in, and I'm drawing a blank.
Golden West, I think, Cy.
Yeah, I think that's it. And then Saturday, that same group of us are doing things, and that is an online without masks. We're not going to be wearing masks, but it is a virtual session, and you can go to the Georgia chapter site on Better Investing for more information. That's this Thursday, Friday, and Saturday. And on Friday, let me just check the schedule. No, it's not Friday. It's actually Saturday. I am doing a presentation that is on Manifest, using Manifest and other sources with our SSG. So that could be of interest to Manifest subscribers. And it really, I think of everybody, because I'll be talking about tying value line into the stock judgments and so forth, but we'll be talking a little bit about Manifest as well.
Yeah, and there is a link to event information and a PDF about the fair on the Manifest Investing forum. And if you'd like me to send that to you if you're from outside the community, just send me an email and I'd be happy to link you up with this information also.
And Mark and Ken have both been past guests at that event. So even though they're not there this year, they're rubbing off a little on it. In fact, Kim was there, wasn't she, when you were, Ken?
Kim was there last year
Yep.
with me. That's right,
Yep.
Si.
Yeah. So it's got a history of some roundtable participation.
All right, one last topic before we open up the floor for Q&A. We are in the small company safari part of the year where we are trying to find promising, interesting, smaller companies, and we're already seeing kind of the floodgates open. Marie Frank published a bunch of stuff. Kim actually sent me some fantastic stuff from a professional firm that specializes in small company stuff, and I jotted down a few names already just as we were coming online. Again, we appreciate over the years, there's always been a number of companies that have come from all of you guys. So bring out your best companies and let us know about them. By the way, in the groundhog contest, Marie Frank is in the catbird seat right now, up at the top of this year's results so far. And she's been one of our small company advocates here over the last several years. All right, Ken, what's on everybody's mind? How we doing?
Well, do you want to record this, Mark, or you want to close the recording and then move on to Q&A?
Let's go ahead and shut it down just because it makes it easier on YouTube.